Good afternoon, everyone. This is Liz Petrelli, your annuity marketer here at Underwriters Marketing Service. Before I introduce the next speaker and get underway, a few housekeeping items. This is a webinar for financial professionals, so if you are not one, please disconnect at this time. Also, this is being recorded, so if you do not wish to be recorded, please disconnect at this time. Also, at the end of the webinar, I will be taking the questions. So if you do have any questions, please use the little hand thing and type your question in, and we'll get to that at the end of the broadcast. So as I said, my name is Liz. I am your Underwriters Marketing Service annuity rep, and we underwriters are your back office support for life, long-term care, fixed, and FIA business. We have been in business now for over 36 years, going on 37, and we are constantly striving to provide you, our agents and reps, with education, support for your business, and marketing tools to help you continue to grow and to develop. We have partnered with some of the top in the industry on the annuity side. Today, that's going to be AIG, American General, and I think there's another U.S. Life for the New York side. We have partnered with them for many years, and they continue to offer great services and products to help you, your clients, with accumulation potential products, and then today, guaranteed income in retirement. Our speaker today is Charles Samuel, and Charles has so many designations after his name that we decided just to say he's the regional vice president, and at the end of the day, he is an annuity wholesaler, and he has about 7 kids, and like I said, he's a very compelling speaker. So, Charles, I'm going to turn it over to you.
Thank you. Thank you so much, Liz. Those are my clip notes. I always say people don't care about me. They care about what I have. So today we're going to make sure that this is an engaging conversation for all of you. We're going to be talking about the Assured Edge. Now, this is a solution that was rolled out to UMS January 4th of this year, and it's available inside and outside of New York. What we have today is we're going to go over the New York version of the product, and there's very small differences between the non-New York and the New York version. So we'll focus on one version of the product. We'll go through this particular deck. It's more than likely not going to take us an hour to go through all this information. In most cases, we can cover this in about 25 to 30 minutes. So we'll cover this deck, and in this deck, we'll talk about the product. We'll talk about why this product is important right now, but at the end of this presentation, we're going to share with you some of the tools that we have available, the playbook that we have for the product in and outside of New York, and more importantly, the calculator. Now, the calculator is going to be huge because there's no password. I'll add the link to the chat, or we'll go ahead, we'll have it sent out to you later, and all you have to do is click on that link, and then you could start challenging me and say, you know what? You said that you can give me SPIA-like payouts. And you're right. You said you can give me DIA-like payouts. You're right. You said that your payouts with the Assured Edge were comparable to payouts with pension plans. And you're right. And then it even has a nice one-pager there. But for a call to action, this is going to be for the individuals that stay to the very end of the call. We have ring lights. Everybody's connecting virtually now, and many people, it's almost like watching a spooky movie because they have their lights set up in the wrong way. But having a nice ring light is going to make you shine when you're presenting this information to your clients. And so we'll tell you how you can qualify for your ring light at the end of our call today. So the Assured Edge Income Builder. When we think about this particular deck, we're going to go over the highlights, we're going to go over the guaranteed lifetime income, and then the product summary. When you think about the highlights of this product, there are a few key advantages of this particular solution. This solution is designed to give your clients an income, and there's no income base. And so why is that important? A lot of times you're looking at these income riders, they have an income base, and the cost of the income rider is based on the income base. That cost is constantly going up while the cash value is going down, and people, they get sticker shock when they look at that income base. And the good thing about this product, there's no income base. And so the cost of the rider outside of New York is going to be based on the cash value. Inside of New York, there's no cost for the rider. The other question that comes up is, okay, so how does my money grow if I give it to you? So I give you the money, how does my income grow? And we'll go over this in more detail later, but it's a 20% or 20 basis point increase for the first 15 years or until the client decides to activate the rider. Is it available for qualified and unqualified? Yes. And this is a really good selling point because many people have qualified dollars. In most cases, those qualified dollars are what's set aside for retirement. But if you're putting it into an annuity, it's single owner, single annuitant. But with the Assured Edge, you can have joint covered lives. So now you can turn that IRA into the JIRA, the joint individual retirement account. And then, the other thing about this product, because you have income riders in New York tied to variable products, but it's exposed to market volatility. And if you don't believe there's volatility in the marketplace today, look at what happened with GameStop and how that's going to have rippling effects throughout the market in this year and maybe for the foreseeable future. And then the other thing that people say is, great, you give me SPIA-like payouts, but with a SPIA, I'm locked in. Well, with this contract, you have access to cash, and we'll show you what that looks like. So when you're thinking about this product, it's really three things, right? We're going to give you guaranteed income by giving you some of the highest payout factors that you're going to find. As an example, I was talking to an individual just before this call, and I asked the question, if you're looking for a 5 for life, how old does your client have to be to qualify for that? And they said, you know what, like mid to late 60s? Well, with this product, we can give you a 5 for life as early as 58. The next thing is, how do we grow? If I don't want to take the income out right away, how does it grow? 20 basis points each year until the client turns until the 15th year, or until the client activates the rider. And then protection. Today people are looking for protection, and we have that. So a question that I love to ask over and over again is, what is today's safe money withdrawal rate? And many people will say, I think it's 4%, or what is a safe money withdrawal rate? And those that know are in the know say, you know what, I don't really think 4% is the safe money withdrawal rate anymore. Why is that important? Because the second figure, the second little column over here, the second figure, talks about people are living longer. So if you're not, if you're looking at if you're using the wrong withdrawal rate and you're living a really long time, you could get to a point to where you're going to run out of money. So we have to ask that question, what is the safe money withdrawal rate? Well, the people that know would say that this is really what you're looking at. You're looking at, from an aggressive standpoint, from a moderate standpoint, or from a conservative standpoint. From a moderate standpoint, people will say that, a safe money withdrawal rate, a good safe money withdrawal rate today would be about 2.29%. So to put that into scale, if your client had $1 million and they were looking at a 4% safe money withdrawal rate, that's $40,000. Okay. Now they're looking at a 2.29% withdrawal rate. That's $22,000. That's almost a 50% reduction in their income. So the question is, what are they going to do? Where are they going to get this income? At the end of the day, when you look at people's retirements, I always like to ask the question, do you want a protected income or unprotected income, a guaranteed income or a non-guaranteed income? And most people would say they want a guaranteed income. However, when you're looking at most people's portfolio, they're on the left side of the spectrum, right? Where their guaranteed income is coming from Social Security and their pension. But the rest of their income for life is coming from other savings and investments. And what we're trying to show them is, what if we just repositioned a portion of those assets into an annuity? Well, why would I want to do that? Well, this slide really brings that home for us. And I really like this slide, and I know it's very busy, but I'm going to pull up my annotation tool and I'm going to highlight a few things here, right? I'm going to highlight a few things because there's a lot of things on this page, and when you highlight it, it just makes it easier. So when you look at this particular page, what we're saying in this scenario, in scenario number one, let's say a client says, you know what, I think I am in a better position to create, a plan that will get me through retirement better than you can. That's self-insuring, right? That's unprotected. And what they're saying is, I need $50,000 in this situation. and $20,000 is going to come from Social Security and my pension plan. That means $30,000 is going to come from something else. So the question is, Mr. or Mrs. Client, are you comfortable with a 40% income reliability ratio? What does that mean? Can you live off of 40% of your income? Are you okay with just guaranteeing 40% of your income? And most people, when we have that conversation, most people will say, no, I don't just want to live off of 40% of my income. I want to live off of more than that. But what happens if there's a market decline of 20%, and now you were taking out 4%, now it's 5%. So if 4% wasn't a really good strategy, you think 5% is better? No, and then you're probably going to get to zero a whole lot faster. Yeah, I don't want that. So the question, if we can increase your guaranteed income, your income reliability by 50%, would that be something you'd be interested in? And some people say, well, what is it? What do you mean by 50%? If we could take you from 40% income reliability, guaranteed income, to 63%, would you want to entertain that? And then they say yes, but they say yes reluctantly because they feel like maybe you're going to try to take all of my money to do this. And that's not what we're doing with this solution. As a matter of fact, what we're doing is, if you look on the, and I'll go ahead and get my tool ready again and highlight this. If you're looking at this, the client gave you $700,000. We still have, $20,000 being generated from their pension. We took $200,000 of the $750,000. We put that into the Assured Edge, and that gave that client an additional income of $11,400. That increased their income reliability by almost 50%, from 40% to 63%, which basically means that even if the market has a decline and now they're taking more money out their portfolio, they don't have to worry about what's going to happen in the market because, well, they do, but they don't, because more than 50% of their income is going to be guaranteed for life. So now maybe they can be more aggressive, or maybe they can not withdraw that money when they don't need it because over half of their income is guaranteed for life. And when people realize that they can have a solution like this without having to exhaust all of their current resources, they feel really good about it. And so we ask the question, do you have homeowners insurance? And most people will say, absolutely, I have homeowners insurance. Okay, well, do you have life insurance? Yes, I have life insurance. Auto insurance? Yep. Well, do you have insurance to guarantee your retirement income? And most people will say, well, what do you mean? Well, when you think about homeowners insurance, there's only like a less than 1% chance that you're going to lose your home to a fire, something major. With life insurance, there's less than a 10% chance of a 60-year-old male dying within 5 years. Auto insurance, there's less than a 1%, or there's less than 1 in 45 registered vehicles that get into a crash every year. But then when you get down to the 401ks, there is, and I like how it says it here, the stock market has experienced a decline of 20% or more approximately every 3 years. So there is more risk in your retirement income than there is for anything else. So the question is, do you want to guarantee it? And most people will say, I'd love to. And then we say, great, I'm glad you're on board with us. And that's why we have the Assured Edge. Now, here are some of the payout factors that we have for the Assured Edge. And the good thing is that this is going to be available for single and joint. When you're looking at the product inside of New York, you have to determine at issue whether you're going to add it's going to be single life or joint life. Outside of New York, you have the flexibility of saying, I'm going to go ahead and go single life. And then you get married and you say, oh, she's the love of my life, or he's the love of my life. And then you say, I want to make sure that they're covered for the rest of their lives. And then something goes wrong, or maybe unfortunately somebody passes away. Well, then you have the flexibility to take that person off. And all of this flexibility takes place before the income starts. And that's outside of New York. So it's single and joint. And when you're looking at the single and joint coverage, we're looking at the age of the younger spouse. And so, from there are more details that we have here. I'm going to skip through some of this only because I'm going to get to the placemat, and the placemat is going to have some of this but I want to make sure that I cover, let's see here, the product summary, because the playbook's going to have a lot of the other details we just passed up just now. So when you think about the bare bones of this product, the minimum premium required is going to be $25,000. The issue ages are between 50 and 80 years old. If they're 49, they're too young. If they're 81, they're too old. They have to be, and that's the current age, not the insurance age. The current age at issue has to be between 50 and 80. In New York, it's a 7-year product. Outside of New York, it's a 10-year product. In California, it is a 9-year product. And here's the surrender schedule for New York. The income can begin as early as age 50. So a lot of times people buy this product and what they'll say is, I heard it was like a SPIA. Does that mean I have to take the income within the first 12 months? And I heard it kind of can beat a DIA. Does that mean I have to wait more than 13 months? So this is the best of both worlds. You don't have to determine when you want to take out the income when you buy the product. And yes, it works like a SPIA. And yes, it works like a DIA. In many cases, it's like a SPIA or a DIA with life cash refund, right? So we pay out for that life, and then whatever's left over upon death, we give that to the beneficiary. If there's nothing left over from a cash value standpoint, there's nothing left over, which is much better than a person would get with the pension benefit. You know, can you take 10% free out amount? Yes, you can. Will we advise that you do that? No, we wouldn't, because when you're buying this product, you're buying it for the income rider. And typically, as a best practice, I'll tell people, you know, since you can add money to the contract for the first 60 days, then you may want to wait until after that 60-day mark before you start activating income. And then you have excess withdrawals. We can get to some of the excess withdrawals, but at the end of the day, there's going to be a pro rata deduction when you're taking out those excess withdrawals, and those withdrawals over the amount that's laid out in the contract. And we always kind of encourage people not to do that. So that's going to wrap up the program, or the deck that we have for the product. What I'd like to do next is I'm going to stop some screen sharing. I'm going to rearrange some things. I want to share with you the tools that we have. It takes longer to explain the product than it does to sell it. And so now I'm going to show you how you can sell it and how you can sell it easily with the tools that we've made available to all of you. This is the playbook. I love using this playbook. I'm looking at let me see here. If I can't put it in the chat feature, I'm looking for the chat feature. I'll go ahead and I'll send an email out to Liz afterwards, and she'll make sure that all of you have that email. This playbook is amazing, and here's why it's amazing. You know, a lot of people that are new to their product, the one thing I always mention to them is, when you're thinking Assured Edge, you're thinking one thing. It's, you know, when you think about the evolution of income riders on annuities, they started with variable annuities. They were the first products to have income riders that can give you lifetime income without annuitizing the contract. Insurance companies realized we can give you more guaranteed income if we took some of the risk off the table. So there was the introduction to the indexed annuities, and the income rider marketplace with indexed annuities exploded. People are like, hey, why take the risk on the VA when I could put the money in this index product and get a higher guaranteed income? That's what my client wants. And they have all this downside protection. Oh man, this is great. And then insurance companies realize, hey, we could actually give you more guaranteed income if we put it on a fixed annuity, a pure fixed annuity. So while the Assured Edge has a guaranteed interest rate of 1%, it is a fixed annuity, and it's built for income. So now I'm going to use that calculator that I was talking about earlier, and I'll do some role playing. Typically, I would do role playing with you, but in this situation, I'll role play with myself. And let's just say you have a client, and I'll give you an example. I was talking to a lady the other day, and she said, Charles, how good is your product? It's great. She's like, okay. And so she's starting to pepper me with questions. And so I say, well, what state do you want to run this for? She says, I want to run it for New York. Okay, New York. And how old is the client? Okay, the client is 60 years old. Okay. And do you know how much money they have? Or do you know what they're solving for? Yeah, they have $250,000. Okay, $250,000. And when do they want that income to start? they're ready to retire right now. So I said, okay, so income start right now and $250,000. Hit calculate. And remember, I didn't log in for this. There's no password for this. You can do this right now once you get the calculator. So if you gave me $250,000, you're 60 years old, I'm going to give you $13,000 and guarantee it for life. Oh, that's a pretty competitive payout. What's the withdrawal rate on that? Right? Maybe they ask the withdrawal rate, or maybe they ask, do you have something that you can give me today so that I can hold on to it, because I'm trying to shop around and I want to make sure, this is comparable to the other options that I have. And typically when you're looking at an illustration, it's how many pages? 15, 16 pages. And I remember when, I've worked in this business long enough to have mentors that have been in this business for 40 years. And they're like, Charles, I remember when the application was one page and the illustrations were very simple. Now they're so complicated. Well, here we have a calculator that was able to give you that one page, and that one page laid it out very clearly. You gave me $250,000. You're 60 years old. Your income was going to start at 60 years old. Your initial income percentage was 5.2. And because you're starting it right now, it's 5.2, and we're giving you $13,000 for life. And now they're going to say, wow, the safe money withdrawal rate is 4%, used to be. The new safe money withdrawal rate is 2.2, and you're going to give me 5.2 at 60? And in most cases, if people are looking to get that 5 for life, they're having to wait till they're 65. So what does this mean for your clients? This means you can allow your clients to retire today. They can retire earlier. Now, some people will say, Charles, this calculator is pretty snazzy. I like that, but I'm old school. And I say, old school? Yeah, I'm old school. Do you have a rate card? And I love using the rate card. And that's another tool that we have inside of our playbook. So if you go inside of our playbook, there's a client presentation, a lot like the one that I just shared with you. So if you want to do this virtually with your client to get them to understand everything leading up to the product, you can do that. But the placemat is right here. And when you click on the placemat, it's almost like running 200 illustrations and presenting it to your client all at once. Why am I saying that? I'll break down how this works and also the math behind the income rider using the placemat. I was going to do it on the presentation, but I'd rather do it on the placemat because you're going to be using this placemat in some of your cases, in some of your sales. Let me go ahead and get my annotation tool ready, and we'll mark this up again. So what we're looking at is basically on the left-hand side, your client is purchasing this product at 65. So I'm going to use everything on this left-hand side from a math standpoint. And then I will reference where we are on that grid to show you how do you look at that grid and how do you read that grid and how do all these things work. Now, you can just use a calculator, but if you're working with an engineer or a doctor, they may want to know how the sausage is made. So let's say your client is 65 years old. The initial payout factor is 5.7, right? We have 5.7 right here, 65, 5.7. Now, every year they wait, there's 20 basis point increase. We multiply that times 5 years, that gets us 6.7. So we go over 5 years and we go down 6.7. And what you'll notice is every year there's a 20 basis point increase, right? And that will continue past that 5th year, but in this illustration, that's when the client is activating the withdrawal. So it gave you $100,000. And remember, there is a guaranteed 1% growth on this product, and they waited 5 years. So if you're looking at the interest of 1% on $100,000 for 5 years, that's how we get the $5,101. You add that to the initial $100,000. Now we have an accumulated value in year 5 of 105,101. Now we say, great. So we have 105,101. We have an increased withdrawal factor of 6.7%. That's at 70 years old. That's going to generate an income to your client of $7,042. And that's how the math works. And so when you look at the placemat for for the Assured Edge Income Achiever outside of New York. It walks you through a similar formula, but the math is a little different for that product. But it's all right there on the placemat that you'll have after this particular phone call. And remember, you don't have if you're using the placemat, you're probably doing it wrong. There are a lot of individuals today, they're not using the placemat. What they are using is there's a sales idea. They use this sales idea and they back into the calculator. And every time they do that, it's a one pager that when the client sees that one pager, they're like, you know what? You're right. I should be doing this. So I'm going to show you where to find that one pager. And then what I'm going to do from there is I'm going to pause for the cause to see if there are any questions in the chat, and I can answer whatever questions you all have at this time. And I don't mind zingers. So if you want to throw a zinger out there and you want to try to trip me up, I'd be more than happy to try to jump over that hurdle, because when you're in front of your client's going to throw you zingers. They're not going to take it easy on you. And so I don't expect you to take it easy on me today. So this is, our national playbook. Once again, another resource, and it's outside of a firewall, outside of no passwords. As a financial advisor, you can go to this information. And if you click on rates and materials like I'm doing right now, and then you go to sales ideas, there's actually a sales idea right there at the bottom right-hand side. And it kind of looks familiar. This is the same sales idea that we had inside of the PowerPoint presentation. And what you're going to see is very clear, right? On the left-hand side is unprotected. On the right-hand side, it is protected. We can take your client from 40% income reliability or 40% guaranteed lifetime income to 63%. And the one thing that when your clients see, and you ask them, where do you want to be, right? And they say, I want to be protected, but they don't have an annuity that's generating guaranteed income, then now they can see for themselves, no, you say that you want this, but this is what you have. And then from there, all you have to do is go to the calculator, run the calculator. If your client wants to have a full illustration, then we're more than happy to run a full illustration for you. And then if you go back to the playbook that we had up, inside that playbook, there are a number of other sales ideas that you may have inside that playbook. And if you go back to, if we just take we cut back to our other playbook, our master playbook, there are all these sales ideas that we have around the Assured Edge, around the product. And on top of this, we have a host of other ideas that we love to walk you through if you have any questions. But today, we did what we said we're going to do. And now for the reveal of how you could win your ring light. So we have these ring lights that we are going to be giving out to the first 5 people that complete their product training for the Assured Edge and send us the certificate. So after this call, I'm going to go ahead and send an email to Liz. And in that email, it's going to have the playbooks that we have for the product. It's going to have the links to the product training. It'll have all the things that you need. And for the first 5 people that complete the product training and submit that over to our team, we will send you one of those ring lights. We already have them in stock. So we can probably get them out to you. Today is Tuesday. I think we may be able to get it out to you by the end of this week. So when you're on your next call, maybe engaging with your clients, you can look your best. And that's all that we have for today's call. Liz, did we have any questions?
We do have questions. Hold on a second. It might be a zinger in here too.
I'm ready.
Okay. Can AIG take inherited IRAs?
Yes and no. So AIG can take inherited IRAs on accumulation products. So the sister product to the Assured Edge is the Power Index Premier that we launched last year. And if you're using the accumulation version of that product, then yes, you can have the income. You can have we can take the inherited account. However, if it is an inherited account where it's a mother leaving it to their daughter, and we can't take those, because right now for our inherited contracts, it's inherited contracts when they're within 10 years of each other, or if it's the spouse. So if it's the spouse, what we'd say is is there a reason why the spouse isn't taking over this contract as her own? And if she does that, then she could buy this contract for herself if it's titled to her. So from the short answer for Assured Edge is no. The larger answer for AIG is yes, but the more specific answer is if they're within 10 years of each other, then we're not going to have any problem putting that on one of our accumulation chassis. But if they're greater than 10 years and they're not a spouse, then the answer is going to be no.
Okay. Someone asked, is EFT available on a new app?
So EFT. So there are two things, right? So can you wire money to AIG? Yes. And we can get you those wiring instructions. And can we send money, like the payments, out via EFT? Yes.
Okay. Can you buy the contract in a qualified plan?
Ooh, good one, but not a zinger. So the short answer to that is I get that question a lot, and right now we don't have it set up to where these can be put inside a plan. So these are contracts that are going to be set up for individuals. However, what I will say is this: I have come across situations where banks, like our credit unions or other corporations, will buy the Assured Edge, and we'll have a non-natural owner, not a pension plan or a retirement plan, but it's a non-natural owner like a corporation, a school, or something like that. And they will be the owner, and the annuitant would be maybe an executive for the firm or an officer of the bank, and they would be the covered life. So we do have situations where we can have non-natural owners that are owning the contract, and then there's a natural life that's being covered at that particular point. So we could do that. Unfortunately, we can't set this up inside of plans or retirement plans.
Okay. Let me see. Do you accept inherited 401ks sister to sister? Not
I think
sure exactly what
that's
that
a
means.
great question. I know exactly what you're saying. So if going along with what I just said at first, so if we have if sister to sister, let's call me a sister. Of course I'm not a sister, but let's say sister to sister, and my sister was within 5 years of my age, not a problem. But let's look at my family. I have 7 children, and my oldest boy is 18. My youngest daughter is 7, right? And so in this situation, for this to work, my son, if he were old enough and had money, he could leave money, and anybody else in the family could stretch it except for the youngest person, right? Because they're outside that 10-year window. So for us, if they're within that 10-year window, they can do it. This is not a law thing. This is an AIG thing. Other companies may be able to take it, but from a process standpoint, we're going to take it if they're within the 10-year window. So if this older sister is 50 years old and the younger sister is, call it 45, we're good to go. The younger sister is 30, then we're out the door. We can't do it.
Okay. Can you talk about the death benefit?
Yes, I'll make it simple for you, right? Because with the Assured Edge in New York, there's no cost for the rider. The Assured Edge outside of New York, the cost for the rider is 0.95%. But remember, it's a fixed annuity earning 1%. So it's almost like that cost, it kind of washes. So when you think about the Assured Edge, it puts you in the mind of a single premium immediate annuity. And that if you gave me $100,000 with a single premium immediate annuity, and I paid out $50,000, right? There's a value of $50,000 left. And if you selected life with cash refund, then that $50,000 refund would go to the beneficiary. Same thing with the deferred, with the DIA, right? With the DIA. So if a person buys a DIA and they die before the payment starts, then the benefit goes to the heirs, right? Same thing with the Assured Edge. And afterwards, if the person dies afterwards, whatever the value is left in the contract, it goes to the beneficiary. So if we're looking at the Assured Edge and they gave me $100,000 and I paid out $25,000, that remaining cash value will go on to the beneficiary unless there are 2 covered lives on the contract. If there are 2 covered lives on the contract, we're going to pay out until the last person passes away. And when that person passes away, whatever remaining value is left in the contract, that will be provided to the beneficiary. So it can't be stretched beyond that point.
Okay, that was good. We didn't talk about this, so I'm assuming there isn't, but somebody asked, was there an LTC rider on this contract?
There isn't an LTC rider, but there is a feature that could help your client in the event that they no longer want income. And that's happened from time to time. I'll never forget, there was a time where on a different product, we had a person that said, after a year being in the product, I don't want it anymore. I'm like, wait, you just bought this a year ago. Yeah, but the guy had a heart attack and now his wife is taking care of him and he can't, change his clothes by himself. He can't feed himself. And I said, oh, he can't complete 2 out of the 6 activities of daily living. That's right. Well, on this product, we have 3 things that you're not paying for that come with the product. There's extended care rider, there's a terminal illness rider, and there's the 2 out of the 6 activities of daily living rider. And with the 2 out of the 6 activities of daily living, if you can't complete 2 of the 6 activities of daily living, then we will waive all the surrender charges. And so now you're not being penalized for having to reach out and access the money that you need for whatever you need it for at that particular time. So while there's no added benefit, like there's no step up because of that long-term care event or because of the ADL event, there is that access to cash.
Okay. Somebody wants to know, and I guess this would be a qualification, does they qualify? But they want to know, since the average on an IUL is 9%, why would somebody go to this product? It doesn't seem like it accounts for compounding growth, but not everybody qualifies for an IUL. So do you want to take that one?
That was some heat. That sounds like a life insurance salesperson. That was like, I'll sell life insurance, and why should they do that? Put your hands up, Charles. I have a life insurance background. So I have my COU, I have my CHFC, and a host of other designations, and I understand where you're coming from. Some people don't qualify for life insurance. And some people, what they're doing, and they're really buying IULs the wrong way, if I may say, right? Because they're not buying it for the minimum face amount, maximum. They're not trying to max it out, right? They're buying it and they're hitting the minimums. And so if they're hitting the minimums, at some point the cost of insurance is going to increase, and they're not going to have enough growth for it to really have the impact that it's going to have, right? And for some people, I would still say that using an IUL is a great solution, because with the IUL, you could pay that thing every year, every month. You could put money into that IUL, right? And then you could have the cash value grow, and now that person has a tax-free retirement. That's great, but what happens when the cash runs out? Right? I think that's the question. What happens if the product doesn't perform like it needs to? Right? And so what I would say is, where the Assured Edge can help is, the Assured Edge is going to give you, and if you do the math, right, the payout factors are I'll just go back to the payout factors to give you an example of why a person may want to do this. As a matter of fact, I know exactly how to explain this. So typically, the other question that I get, and I want to do a quick screen share. The question I typically get at this point is, I could do what you're doing with my managed money. And it's kind of almost the argument here. It's like, if I can get 9% on the IUL, why would I put my money in this? And so it really goes back to, how much money would you have to put in an IUL to generate the income that we're going to generate on a guaranteed basis, where your client will never have to worry about running out of money. And when you do that math, it may be a different answer. And typically, when I'm answering that question, I'm talking about assets under management. So what I'm going to do is this. I'm going to answer that question by focusing on this page with the assets under management slant, and then I'm going to come back to show how I think you can still have the IUL come in to complement this. And so typically, when people are looking for guaranteed income, I ask the question, when you think about that, it's people are generating income from their investments and their savings. And my question is, how much does that cost? Because typically, people are getting their guaranteed income from their Social Security or their pension. It's guaranteed lifetime income. And typically that person, those individuals have gaps. So they have, say, $20,000 coming from Social Security and pension, and now there's a gap of $30,000. How do they close that gap? Well, typically, if they're closing that gap and they realize that the safe money withdrawal is no longer 4%, and they're probably going to be using 3% or less. Now, to your point, what about compounding? We could talk about compounding, right? But if we're just talking about the pure cost, if you're trying to pull 3% off of a value to give you $30,000, you need $1 million. We're just saying simple math. 3% of $1 million, right? $30,000. Now, on the other end of that, if I can give you a 5% payout factor, and we showed you that, then I only need $600,000 because I'm giving you a higher payout factor. I'm just saying simple math. So 5% of $600,000 is going to give you $30,000. Here's the difference between the Assured Edge and everything else that you may want to do, right? With the Assured Edge, I'm going to give you $30,000. That $30,000 is going to be guaranteed for life. In New York, there's no cost for that on this product. If you're going to do that on a variable annuity, it could cost you 3 to 4%. So on $1 million, if you're putting $1 million in, that's $30,000 to $40,000 a year. On the Assured Edge, there's no cost. Now, on the other side of that, if you're looking at your portfolio or some other way of generating that income, let's say you had to put in $1 million. That's not guaranteed. So you're spending an additional $400,000 on something that's not guaranteed. So my question is, if your client has an income gap, doesn't it make sense to solve or close that gap in the most efficient way possible? So why not give them the highest amount of income for the lowest cost? And in this situation, if that client had that money in the market or in some other vehicle, I'm not trying to take all of the money. I'm just trying to carve out enough to close that $30,000 gap. Now, what they could do with the other $400,000 is they could max fund an IUL. Let's say they don't qualify for an IUL. They could take that money and take it back to the market, and now they could make riskier bets on the market that they probably wouldn't make if that money was set up to generate all of their income. But now, since they separated a piece of that pie, right? And they know this is guaranteed. Now they can be more aggressive over here, and that can help them to keep pace with inflation. And so really it's about how do you allocate and how do you blend these different strategies. And the people that are using these products the most are individuals that are money managers, individuals that understand how that works. And our average ticket size for the Assured Edge is between $250,000 to $300,000. And right now we're getting people coming to us for $1 million plus because they realize leverage. And they're saying, man, typically I use my bond portfolio, or typically I may use my preferred stock, but I like this plan because it gives me guaranteed lifetime income and it allows me to be more aggressive. So hopefully that answers the question as it relates to the IUL. I think IULs are great as it relates to how people use them, especially when they're using them the right way. However, at the end of the day, IULs aren't designed for generating lifetime income. They're designed for life insurance and they have added benefits. This is designed to generate the maximum amount of income at the lowest cost.
Great answer, and the person who asked that question thinks your answer is awesome. Also, somebody wanted to know about underwriting. There is no underwriting with annuities. Yes, I will send this recording out because I realize that Charles is probably the best speaker ever, and you want to give him all your money. Yeah, I know you love that. Also, so is it anytime income, or do they have to wait till the anniversary date?
They could take it at any time, right? So you could buy it
So
today.
as long as they have the form, that's it. Okay.
You don't have to wait till the anniversary. Yeah.
You do or you don't?
You don't. You don't have to wait till the anniversary. I'm like, there are benefits. So if you know you're a month out from your next anniversary and that's when you would get that next increase in pay, I would wait that month, but you don't have to.
Okay, because any time is good. Okay. So I think you did answer the question about this product versus a variable, the fees that are associated. I guess I would sum it
Huge.
up.
That's
You have
the fees and
any
the
other
payout.
picks?
The fee. I'm not gonna say the insurance company's name. I just had a phone conversation with a guy. He's like, "Oh man, I'm probably gonna give you guys 10 million this year because I write a bunch of this other company's product between the ages of 50 and 60. And most of my clients are looking at waiting until they're 65 because that's when the payout goes to 5%. And you're showing me that your payout goes to 5% at 58. That's all I need to see because for income now, you're gonna be my play. Now, some people will say, well, if I want income later, do you still win there? I'm gonna be honest with you. We dominate income now, income soon, income within 5 years. As you started to move out, there are other solutions that are positioned to win there. We have some, and other carriers have some. But as it relates to the maximum amount of income right now for the lowest cost, you'll be hard pressed to find a solution better than the Assured Edge. And that's in and outside of New York.
Well, it does sound like it. It does sound like it. I think I covered all the questions. There was quite a few getting thrown in here. If I missed something, you can always reach me, obviously, at 800-524-1774. Like I said, I definitely will send this presentation out to all the participants today. And I think that's it. Was there anything else, Charles, you could think of?
Don't forget to win your ring light. I'll send out
I
an
know.
email because I can't
Yes.
tell you how many times I've joined a meeting and people will see me and then their camera will be on and then they're adjusting because they're like, man, this guy, he's really got it figured out. And let me tell you, with just a simple ring light, that will separate you from so many people, right?
All
And
right.
that will help your clients engage and be engaged with you and then help you to drive business forward. So we want to help you with that. So we'll send out the
Absolutely.
instructions after the call.
Absolutely. All right, Charles, thank you. Ladies and gentlemen, that concludes our call today. If anybody has a question that I didn't answer or didn't get to or I missed, please reach out and call me. I will get everything that Charles said that he would send to you out. So thank you, everyone for joining us today. We appreciate you spending your time with us. And like I said, if you have any questions, please call us. Thank you.